The Rebel Capitalist Show. You were talking about the basically all the sovereign nations, the major players. We're talking about Japan, China, the United States, Russia, Saudi Arabia, starting to price their oil for gold, or maybe more specifically, using gold as a reserve asset instead of treasuries, because we need something that is a neutral reserve asset, because I think the way Keynes described it during Bretton Woods, and I've heard the IMF say that several times. So I guess it's about the world moving to a neutral reserve asset that isn't controlled by any country, and you think that's going to be gold. So I think that's your end game. Can you go ahead and maybe give us your version of that?
Yeah, I think at least in the intervening term, it's gold. I mean, it could. There's no reason it couldn't also be Bitcoin, something like Bitcoin. But that's right now, gold's on central bank balance sheets. Bitcoin isn't. And so we'll see how that develops. But I think when you look at the combination, the fundamental problem is that in order, peak cheap energy combined with the sovereign balance sheets of the world, in particular the West, and in particular the reserve currency issuer US, means that in order to keep treasury bonds, and we'll pick on treasuries because it's the reserve currency issuer, Europe has some similar problems, but to keep treasury bonds nominally AAA rated, you can't, by definition, keep them AAA rated on a real basis, particularly in oil terms, right? So basically, peak cheap energy means it's getting more and more expensive to grow and find the marginal oil barrel. That's likely to continue. And while there are some alternative energy things we can do, the fact of the matter is oil and gas are still, 70-80% of our global energy consumption. And that's not going to change in a time horizon that I think is relevant for this discussion. So oil is going to keep getting more expensive if you take out sort of, cyclical moves, right? So oil is going to rise, which means treasury bonds, particularly with rates at 0 or 25 basis points after today, I suppose, are going to lose value against oil just on the geology of oil alone.
Right.
And then when you take into account the sovereign balance sheets of the West, of the US specifically, you have this situation where they can't afford to let rates rise very much to compensate you for the rising energy costs. And so they're going to have to basically at some point grow their balance sheet to, they have to keep real rates significantly negative. And we've seen that. And you and I talked a year ago, and I said, look, I think real rates are going to at least -5, maybe -10 or 15. And people at the time were kind of laughing. And of course, they're not laughing now. Here we are, -8. So it's this fundamental problem where to get the West out of the problem they are with their debt load, particularly in the context of a peak cheap energy world, you've got to have significantly negative real rates, but that, and particularly in energy terms, but that doesn't work if you're a creditor. That means basically you have an ice cube of savings that's melting away at 8 to 10% per year in energy terms, which really matters because if you don't have enough energy, you're going to starve, economy collapse, a whole slew of bad things that political leaders.
Yeah, Luke, why don't you give an example of a country that would be applicable to? Because I think that'll help the listener kind of get their mind around what you're saying. So if you're a country, I think the way you termed it with Grant is if you're long dollars and short energy, then
you're China.
You're holding onto those dollars in treasuries. And if the treasuries have a negative real yield, then your purchasing power, or how many barrels of oil you can buy with those treasuries, is decreasing. And that's bad news if you're a Japan or a China.
Japan, China, Europe.
Yeah.
And quite frankly, it's bad news for Russia too, right? You sell a bunch of oil today at 100, and then in 10 years it's 400. You would have been better off just leaving it in the ground because you're not going to get compensated with interest with rates at 0, and the U.S. can't let rates rise enough to do that. So that is both sides of the coin. It doesn't work for anybody. It doesn't work for the U.S. middle class or working class. It only works for sort of this narrow set of interests that are closest to closest to the dollar system. So I think what we're seeing is the system feeling itself out, the different players trying to enforce their desire to move to a system with a neutral reserve asset, right? Because at the end of the day, gold is just a 0% yielding bond, right? Okay, so Treasury is 0% yielding bond, gold is 0% yielding bond. Gold is infinite duration, Treasuries finite duration. Gold is finite issuance, Treasuries are infinite issuance. And gold has an infinite face value and Treasury has a finite face value. And you could use some of these, apply some of these same things to Bitcoin, and it's even more attractive, I think, on the issuance side than gold is. But the point is that in the situation where we are with energy, with sovereign debt where it is, you need to move to a system with a neutral reserve asset. And if you don't do that, volatility is going to rise, and the system's going to you're going to increasingly see commodity producers decide, you know what, I'm just going to leave it in the ground. I would rather have oil than treasuries, so I'll just leave it in the ground. I'll take out what I have to take out and to pay my dollar debt, and anything else I'm going to leave in the ground, and the system will break down.
Do you think the pushback from the central planners would be, okay, we want a neutral reserve asset, but we don't want one where we can't control the supply? And because when I go back to the IMF, they kept talking about the digital SDR. That they want to be kind of the neutral reserve asset you're referring to. It's just with all these central banks around the world, I understand why they would want to replace treasuries with gold, especially if their problem is energy. But replacing their reserves with something that constrains them to a certain degree, I think they would see as less than ideal. Obviously, I think they'd like to have it where they could print their own currency to buy the energy, but then that potentially puts them in the same position that the United States has been in with Triffin's paradox. So, how do you see that playing out?
I think the ESDR or something like that acting as some sort of neutral reserve asset probably would have worked up until 3 weeks ago, or 2 weeks ago, right? Because now, not only did the US and EU say that your dollar and euro FX reserves are no good, Russia, but a week later they came out and said IMF SDRs are also no good, Russia. So I think they basically, in a week's time, put a bullet in both of those options. And so you kind of go through the balance sheet and it's like, all right, well, FX reserves, there's a bullet in that one. IMF SDRs, there's a bullet in that one. The only thing left there is gold. And so, can they come up with something else in the time frame that they probably need to get this done, given what we're watching in terms of, assuming things don't get resolved in geopolitically quickly with, no, I don't think there's anything else to fall to. I think it falls to basically gold, at least for the time being. And then maybe you can move to something else. You tie the SDR to it, but I don't think they have a lot of choice at this point because they've discredited all the other options, in my view.
Yeah, and what's interesting is your hypothesis is they may have done that on purpose. So meaning that, like the United States, the West, let's say, they say, okay, we're going to freeze Russia's reserves to send a message to all the other central banks around the world that they need to unload treasuries and start loading up on gold so we can transition into this new type of reserve asset system and move away from the Bretton Woods 1.0 system.
I think there is in any country, multiple factions in Washington. And I think there is a faction that didn't like this idea of freezing the reserves. And I think you can see that if you read the headlines of the weekend before they did it. You had JP Morgan and Citigroup and Jamie Dimon warning that, look, this has dollar implications, right? Which is interesting, right? People say, well, I listen to Jamie Dimon on everything. Jamie Dimon saying, hey, don't do this. This has dollar implications. And then after they did it, people are like, well, this doesn't have dollar implications. It's kind of like, but no, I think there are factions within the U.S. like there are in any government. I think there is the sort of Fed Treasury faction that really like this dollar system. And look, if I was sitting in their seat, I get why they do it. I think at some point you have to start being a little bit more selfless and look to the country. But it comes down to a belief system. And so, look, this has been a great system for them. It's been wonderful for them. And so you could see them angling to not do this. Defense, on the other hand, has been very vocal for 10 years, talking about defense supply chains and pointing out that that basically we've been borrowing money from China to build weapons to face down China using Chinese weapons or Chinese supply chains and Chinese components. And I mean, that's literally probably the only economic relationship in the world right now that makes less sense than the German-Russian gas thing that everybody's been making fun of the Germans for. But I guess when you live in glass houses, you probably shouldn't throw stones. But like, it's way more ridiculous that we literally are considering China our number one adversary for the next 20 years, and our defense supply chains don't work without China. Using money we borrow from China. I mean, it literally makes no sense. So there's these two factions of defense, and defense, they've sworn an oath to the Constitution, and they care about logistics. War fighting is all about logistics. And they're looking at their supply chains going, good God, right? If this is our most likely potential adversary, this is a disaster. And so they've been angling for this for 10 years. So I think there's these sort of two factions of sort of Fed, Treasury, defense. And in my view, one way or another, it looks like defense kind of won. It allows us to project and wield this dollar weapon, but ultimately it gets us to an outcome that I think is a prerequisite to being able to restructure U.S. supply chains and start to rebolster the American middle class and working classes again in a way we haven't seen in 40 years.